We do have minutes to approve in the packet in front of you, I believe. The minutes of the 24th. Have people had a chance to take a look at them?
I'm going to move that we delay approval
Okay.
until next week. Can't we get them in at least the night ahead of time so we can read them before we walk in here?
Probably. I mean, it's a question of when they get done, right?
Yeah.
So I think at least we have them now. I don't mind delaying the vote until next
Thank
time.
I will point out that my name is mentioned 5 times, and the last time it's misspelled.
Oh,
It's not even the spell check, is it? Maybe she's just trying to make sure you're reading the minutes.
oh, you're right.
Okay, so we'll put those off. The first item on the agenda is once again a discussion with ex-selectmen. We don't have any here, so I'm going to, I talked to the committee about keeping that agenda item on there so that we could have people whenever they're able to be here. I'm going to take it off going forward, and when we have people available to talk, I think I will just ask that we move up public comments. We can then close public comments after they're done speaking and reopen them later at the end of the meeting as well, so that people don't miss an opportunity. But I think I got some feedback that the presence of that item on the agenda is confusing some people. So I think it's better just to take it off as we go forward. Okay. Agenda item 2. Tonight, we are fortunate enough to have a member of the Finance Committee here. I'd like to introduce Amina Langford. She is, as I said, a current member of the Finance Committee here in Chelmsford and has been for the last 3 years. She's a graduate of UMass Lowell with a BS in Criminal Justice and a Master's in Taxation. She's worked as an accountant and an enrolled agent for the past 14 years. 4 years ago, she took over a small firm for which she had been working and is currently the owner of Donovan Langford Accounting in Woburn, offering full-service accounting for individuals and businesses of all sizes. I think I'll stop there. I will just add a personal note that I've had the pleasure of working with Amina in the past, and she's smart as a whip and a straight shooter. So I'm very pleased she's here tonight, and I'm looking forward to this discussion. Amina?
Hi, everyone. Thank you for having me. So Mike had actually sent me some questions that I'm guessing you all put together. I thought maybe I would just address those questions from the email one at a time, and then if any follow-up questions come around, we can go from there, okay? So the first one was just sort of how personal income tax work and how they're affected by the new change in the property tax. Everyone's calling it the new SALT change. SALT stands for state and local taxes. If anybody here has ever, or at home has ever itemized their taxes, you'll know that you can, when you do that, deduct both the state income tax that you paid out over the year from whether it be your W-2 or your retirement, as well as your property tax, your real estate tax, and your excise tax on your vehicle. The excise tax that portion is not being changed when it comes to the new policies or the new tax law. The biggest change is the fact that they are now combining the line that used to have your personal state income tax that was withheld for the year and the line that included your property tax, your real estate property tax for the year. They're combining them on one line and they're capping it at $10,000. There's no sliding scale. There's no, well, if you only make this much, you can take more. None of that. 10,000, everybody. This will not affect anybody's state income tax returns. This is only a federal rule. The state has not changed any of their tax laws for 2018 that we are aware of. It is the Department of Revenue, you just never know. But nothing has changed. The legislature doesn't even have anything in their dockets that would change anything for the state taxes that would be affected by this. As far as I understand, the amount of deduction that the amount of reduction that we're talking about is about a few $100s per person. To be completely honest, that's not going to change many people's returns. If you're reducing, the majority of people in this area, when I say this area, I mean Middlesex County, they're going to be hitting the cap. If you work and you have income tax taken out, or if you have retirement other than a public safety officer or teacher retirement, which is not taxed in the state of Massachusetts, therefore nothing is being withheld, you have withholding. If you W-2, pension, IRA, that sort of stuff, you have state income tax being withheld. In combined with the average property tax in Middlesex County, you're reaching, and the average mean income in Middlesex County, your married couples are reaching if they both work, are reaching the threshold. That's just a given. That being said, one of the other changes in the tax law is that what was once just a little over $12,000 as your standard deduction is now being bumped up to 26 for, well, yeah, if you're over a certain age. But it's right around, it's going to be bumped up to right around the 24, 26 range, 26,000. So the majority of people who itemize are not going to anymore. The people that this sort of a policy of reducing their real estate taxes are going to be looking at, the ones that are really interested in it, are going to be my clients who are retirees, the ones who are on a fixed income. They're all going to be getting the newer standard deduction. I don't have any retiree who has itemized deductions over $26,000. So they're going to go from having itemized deductions around 18 to 20 is the average, to being able to take that new higher one. So this, again, then wouldn't even affect them, because they'll be taking that higher standard deduction, in which case you cannot deduct property tax anywhere else on your tax return. The only other caveat to that would be if you own your own business, or if you are a shareholder in a what we call pass-through schedules, an S corp or a partnership is what we consider a pass-through, meaning that when that business makes money or loses money, it's not taxed as a corporation. That profit or loss is flowed through to your personal return, and you're taxed at your personal income tax bracket, whatever that might be. Those are changing. They, many people want to say they're being lowered. In a way, they are. We still have a large number of brackets, but the people who fit into the lower ones are going to be greater. The threshold to bump you up to the higher tax brackets are much higher now. So a lot more people who would have been taxed at, say, 33 to 35% in 2017 will now be taxed at 28, 25, depending on where they fall in that. So as I had said to Mike when I spoke with him earlier, the majority of my clients are going to see more money next year from their refunds. And that's for a number of reasons. One is that as I had mentioned, the standard deduction is doubling. The other thing is that there's a lot of credits on the return that people couldn't qualify for before. But the threshold to we use to age out of those, is much higher now. So I have clients who couldn't get child tax credit before. They'll now be getting it. And they'll be getting it more than they would have gotten it before had they even qualified, because the actual credit is going up. We have clients who are going to be able to take the American Opportunity Credit for college tuition that wouldn't have been able to take it before because the income threshold has gone up. So a lot of people are going to be seeing a lot more of a refund. Now, there is a flip side to that. There are some people who make a lot of money, who don't have a lot of deductions, who are not. They're going to actually, their tax rate might go up. It might seem like it goes up, because what's going to happen is they're having taxes taken out of their paycheck that's less than it used to be, because the payroll rules have changed. So now when it's time to do their taxes, it's the same, it's going to be about the same amount, but it's going to be more at the end versus more at the beginning. You had asked for me to do some modeling on high-income family, average income family, low-income family. That's really difficult to do, because if you make $100,000, there's a lot of other factors that determine what you're going to owe. And it's not just a reduction in your property tax. It's, do you have dependents? Are they in college? Are they in daycare? Where do you get your income? Is it W-2, or is it you're a small business owner and that business is on your return? Are you retired? Are you on Social Security? Is it a Roth IRA that you're getting your money from, which is tax-free anyway, or is it a traditional IRA? Lots of questions that can go into this. I could go on and on. But so long story short, there's no way that I could come up with scenarios for each of those brackets that would be comprehensive and appropriate for the committee. So as I had mentioned, a $200 property tax decrease for the average Chelmsford homeowner is really not going to affect their taxes much. It's not going to affect their refund. Like I said, the majority of people are going to switch from itemized to standard, so they won't even be taking it. And the ones who do, it's $200. On average, it's $200 off your income. It's not $200 off your taxes. So, let's say you're in the 20% bracket, so you might be getting about 80% of that 200 back, maybe. That's a big maybe, because I don't know what your below the line taxes are. So I don't know if there are any penalties on you for, taking an IRA early or something like that. So again, that's not a big difference on someone's tax return. Now for businesses, Mike asked if, let's see, any changes in the way pass-through entities are incorporated based on the new tax law changes. The only one that I'm anticipating and that I'm seeing now is a lot of people are going to S-Corp when they're incorporating. They are not becoming a regular corporation. And the reason for that is even with one of the higher tax brackets, you're paying less than corporate tax. The corporate tax rate is 33%. It used to be higher. Now, not only are you going to pass through that profit to your personal return, you're going to pay a personal rate, which let's say for argument's sake is 28%. You are also getting a 20% what's called a qualified business deduction, which is a new fangled thing that's on the taxes next year. And that's 20% off your profit right there, just right off. So if you made $100,000, $20,000 of it right there is tax-free. So you don't get that if you're a regular corporation. So we will see a lot more pass-throughs. And the way deductions are handled with a pass-through versus a regular corporation, exactly the same. You can write off your property tax fully. If you do not own the property you're in, but you have to pay the property tax to your landlord, you can write it off. It has to be in the lease, though. So, some people get away with it and they do it anyway, but if you're ever audited, you have to show documentation that you are required by the owner to pay the property tax as part of your lease. Sometimes it's directly to the owner. Sometimes they actually write the check out to the town or the city, but usually it's directly to the owner and it's in the lease. Let's see what else. So I think that's about it. I have not heard. I work in a town that has a split tax rate. I pay a different tax rate than I did when I lived in Woburn as a business owner there now. I don't hear anybody talking about it, to be honest with you. Woburn's had one for a really long time. I don't know a lot of business owners in Chelmsford, so I'm not entirely sure how that market is looking at this, but I can say I haven't heard really anything about anybody complaining that they wish, I'm in the Rotary in Woburn. I don't hear anybody complaining that they wish Woburn had a single tax rate. I think it's an accepted practice. So that's about it. I wanted to give you guys a little, because they've just been released, a little preview of what your tax papers are going to look like next year. So when they told you that we were going to go from 2 pages to like a postcard, kinda. This is the first page. This is the second page. So kind of like a postcard front and back, except all the lines that are missing are on separate schedules now. So while we used to have Schedule A, B, C, D, and E, we still have those. We now also have 1 through 7, Schedule 1 through 7, which is all of the lines that used to be on these pages. So I thought since they just came out, and that I would bring them with me and you guys could take a look. Okay, any questions?
Do you think those forms are going to be easier to navigate through
No.
for the average person?
No. I think what's going to happen is people think that they're going to be easier to navigate through. They're not going to realize that there are all these schedules. They're going to get in a little over their heads. And people in my profession are going to be sort of cleaning it up in years to come.
Vote of confidence.
Because it is deceptively, when you see that it's 2 pages, like, oh, this is a breeze, I can do this. And then you do it, and you don't delve into it, and you don't realize that there are all these rules about all, the other numbers and the other pages, and, yeah, it's going to be difficult for people.
So everybody who thought that they were going to get rid of your profession.
Yeah, no. No. And not,
Profession is going to double.
I will say this, that not only that, but it's actually, for the clients that I will retain, it's not gonna be easy for us either. Because instead of me being able to look at lines on 1 or 2 pages, I'm gonna have to jump between, 10 pages, potentially, with all these, because they all sort of intersect. Credits on one page are determined based on penalties on another, or income on another, so you have to sort of jump between them. It's gonna be interesting. My end of the year tax class that I do with the IRS is gonna be quite interesting. No one's falling asleep this year.
I'm not even certain I followed all that you said.
That's all
but
right, yeah.
Let me just sort of see if we can simplify.
Please.
What you have said is that like a split tax rate or somewhat lower taxes for residents.
Correct.
Are unlikely to affect the amount of federal income tax they pay.
Correct,
Okay. Now, for corporations?
yes.
All corporations, or is it certain kinds of corporations, the ones that are entitled to this?
The 20% only pass-throughs.
Okay, but they can write off property taxes?
Correct, as long as they own the property or it's written in their lease that they're
Okay.
to pay that.
And is there any cap as to how much
No.
they can write off?
Nope.
So increases in their taxes would affect how much federal income tax?
Correct, yes, yep.
Well, it wouldn't mean they could write it off.
It means they would be able to write it off, meaning it would reduce their tax liability, it would
That's what
reduce
I'm-
their
yes.
taxable income.
What I
Correct,
was
yes.
saying, I thought that's what I was
Yep.
implying. Enough to balance off what that increase in taxes?
No.
No. Okay.
No, not enough. I mean, well, it's not gonna be equal, it's not gonna be dollar for dollar.
Uh,
The corporate tax rate's 33%. So they, it would reduce, again, it would reduce their taxable income by that $2,000. So if you made $100,000 and you didn't have, like, your profit was $100,000 in 2017 when you were paying the other rate, you were taxed, and that was your taxable income. You're taxed $33,000 on that. But if you knock off 2,000, you're paying a little bit less. So you're paying, probably about, like, I don't know, round it out, about $1,600 less. You're paying, yeah.
Sorry,
Way
where
I
does the
always look
30,
at it.
Income is about $1,600 or $1,700 less.
where does the 33 come from?
That's the percentage of tax that you pay. So if you're taking the fact that you're shelling out this money for for property taxes, but then you can write it off on your tax return, how much is actually back in your pocket? Well, like $300-400.
I thought the new tax rate on this new bill is 21%.
Not really,
Not really.
no,
Okay, that, okay.
not really. You have to kind of look at it, it can be. I'm not seeing any clients that are going to be at that 21. Yeah, there's caveats to the 21 for corporations.
The 33 is
The 33 is about
for
what most people
for
would
a
do.
C corp or
C Corp, yes. S Corps, the pass-throughs, the partnerships in the S Corps, those pass through to your income tax return. They are taxed at your personal tax rate, whatever that may be.
but it's the
In addition, you get that 20%
it's the
off.
income that passes through or the
The profit or the
that
loss,
passes through
yes.
or the loss, right?
Correct. Mm-hmm.
So well, I'll let other people. There must be other questions.
Well, the way I kind of look at, if you're spending $1 more in taxes,
Mm-hmm.
and you're at a 33% tax rate, you're gonna save 33 cents on each dollar you spend on, incremental dollar you spend
Yeah.
on
Yeah.
taxes. That's the
It's a way to
simple
look at
math.
it, yeah.
Like,
Say
a lot of
that
people will
again,
say they
please.
wanna buy equipment or whatever for
Right.
depreciation. Okay, you're gonna spend $1, but you're only gonna save,
Right, because you have to
33
depreciate,
cents.
right, and not even, fully, because not everybody depreciates the full amount every year.
Right.
So it could be over years. This is one that you have to take it in the year you spend it. And 100%.
You said the majority of people that you are in Rotary with
Mm-hmm,
that have businesses
yes.
have not complained about it?
I've never heard anybody complain about us, but Woburns had a split tax rate for a really long time, so it's not a topic that comes up.
But businesses are still going in there.
Correct.
Much different tax base. and
But it's a
whatnot.
different tax base, and it's much more appealing, I mean, at least from my standpoint. It's just, it's a little more appealing to the business owners. because of the facilities and the convenience. At this point, anyway.
Do you have clients who are property owners?
Yes.
And what's their feeling about, not the federal tax code, but how do they feel similar to businesses that are paying rent?
No, so if you own property, now you're talking about someone owns their own home?
Commercial, no,
Oh, commercial. They can write everything off. Yep, even if you, for example, owned a two-family and you rented the two, or like upstairs and you live downstairs, 100% of 50% of that property tax, the upstairs, is completely deductible. If you owned a two-family, you rented the whole thing out, the entire property tax you pay is deductible. There's no cap. It's only capped on your personal home.
So what's this notion with the triple net lease then? If commercial property owners can deduct 100% of their
Yep, their property tax.
property tax.
Assuming that it's fully commercial, yeah.
Okay. I must be missing something.
That's what I thought too.
But Woburn doesn't have the issue with trying to attract businesses.
Correct,
Um,
correct.
So that's a big
I rarely,
aspect.
yeah. They're even building new, right around the corner from my office, they're building a brand-new office building in across from Cummings Park.
John?
I actually don't have any questions. You did a very nice job. Cleared some things up, some things are still a little cloudy,
Yeah,
but
it's,
that's okay.
tax law's murky. It's not straightforward. There's a reason I have a job. But it's also the reason that people have to be careful about assuming what you read on the internet is true. I have a lot of clients who came in this past year saying, hey, I heard I can't deduct medical expenses next year. I'm like, no, you can still deduct medical expenses.
No.
So they said, oh, well, I read on this and I read on that. So I tell people, unless you've talked to a tax preparer, someone who does this for a living, do not believe what you read on the internet. It's not it's not an easy thing to go through, even with the changes. The changes were hundreds of pages. And I'm not a lawyer, so reading a bill like that was incredibly confusing. I had to go to a class and have someone talk to me like I was two. Read it and tell me what this means in my speak. So it's not an easy thing to wade through.
So you covered things from the micro level. I just wanted to cover a few data points
Sure.
from the macro level. This, according to the Internal Revenue Service, in 2016, the latest year for which they have data, federal revenue, 8% came from the corporate income tax, 40% came from the personal income tax. The corporate income tax used to be close to 30%, by the way. The Congressional Budget Office, their estimates of the impact of this new tax bill is that the estimated reduction in the individual income tax for 2018 will be $75 billion, and for corporate taxes, it will be $129 billion.
Okay, that's interesting. I didn't read that.
Yeah, and
I'm not surprised by the first number, where you said 8% was corporate, because that doesn't take into account the pass-throughs. That doesn't take into account S-corps and partnerships, or even sole proprietors. So, small businesses.
Will those be reflected in the income tax?
Those will be reflected in the
So,
personal income tax.
Yeah, so John, maybe some of the trend that they're seeing is a move
well-
towards pass-throughs.
Some-
for-
And yes, they
Some of
were,
it.
because the IRS agents who come to talk to us at our annual and sometimes quarterly meetings, they were very clear that in the last few years, they have started targeting. They don't look at C-corps so much anymore. They're looking at S-corps. They're looking at partnerships. A couple years ago, they said S-corps and sole proprietors were the ones that they were auditing the most. Last year, it was partnerships. So if the trend is heading that way, then that would make sense, that
Wow.
that's who they were looking to.
that could be part of it, but the trend is much bigger than that. With respect to the distributional impact of the personal income tax, this is from the Tax Policy Center. In terms of the percentage change in after-tax income, for the lowest quintile of taxpayers, it's going to go down by 0.4%, or $60. And it goes up from there to the top quintile, where it's going to go down by 2.9%, or $7,640. So
Well, okay, yes and no. I mean, it says that that's what the brackets are doing, but you have a lot more people that are going to be able to get credits
But
off of their.
this takes that into account. This is after all that's done, as best they can ascertain that, I mean, it's
Yeah,
been,
I think it's- yeah,
it's
I
been
mean-
widely analyzed that
Yeah.
this particular tax bill is making the tax system much more regressive, or much less progressive than it is now.
I would
More
agree with that.
regressive, if you look at it
Yes.
another way. And then just, this was just a article in the New York Times, tax bills winners and losers. I just thought I'd identify a couple of them I thought was interesting.
I'd be careful with that one. I read a couple articles in both the New York Times, the Washington Post, and the Boston Globe that were inaccurate.
This is just observing, and I don't think anybody would argue with
Yeah.
this, that in terms of winners, big corporations. They don't say businesses in general, they say big corporations are winners with this tax bill. I don't think anyone would argue that.
No.
Also, tax accountants and lawyers are winners. And then in terms of losers, individual taxpayers in the future.
I think that depends, but,
Well,
I
no,
mean,
with
I
the
can only
sun-
talk about what's happening
With
now.
the sunset clause, clearly, the elderly, low-income families, and people in high property tax, high-income states.
I agree with the last one, because it's capping a lot of people's, the property tax and the income. I don't agree with the other ones, and we could go into that, but that's not what we're here. But I do agree with the last one, that the new rules with the capping of the income tax and the property tax, it just so happens that every state that has high income, or every area that has high income tax rates, also have high property tax rates. So the people that live in those areas, yeah, they're gonna get hit harder than the people who don't.
And they're also blue states. Go figure, right?
Go
For
figure.
now,
Yeah.
yeah.
One other observation.
Sure.
We had a previous speaker who was from Bentley University. Now we have one from UMass Lowell. We're picking the right schools to bring
They
people
are
in
good
from.
schools. I do have a couple of things.
Sure.
I don't want to put words in your mouth, but would you
Sure.
would you agree or would you disagree that if we're looking at this exercise as trying to have a particular effect on individual residential taxpayers,
Mm-hmm.
there's no good a priori way to predict what their outcomes are going to be.
Correct.
That the other changes in their tax situation are likely to outweigh.
Not only that, this is a tough year to do that. We're not entirely sure how this is all going to play out. They just released the forms, and they're only drafts, so they could very well change before, I mean, they will change before January. The class I usually go to in the summer made us all sign up for another one in November, because the IRS is still getting their arms around this. This is probably the toughest year for you guys to look at this and look at its potential impact on individuals, because things are changing. And we don't all really have a big handle on what next year is going to look like, or even 2019 for that matter.
Okay. When we talk about the situation of a small business, or I suppose any size business that's leasing, yeah, you mentioned that they can deduct the property taxes if it's written into the lease.
That they're required to pay it as
That
part
they're
of their lease,
required to
yes.
pay. And in that case, the landlord does not get that deduction?
Correct.
Okay. But if the
Well, no, that's not correct. So the landlord has to claim that income. If they claim that income, so if you write a separate check for, let's say, $2,000 of property tax, the landlord claims that income as $2,000, they can then write $2,000 off on there for the property tax that they then paid, because they wrote the check out. If you write the check directly to the town of Chelmsford, then no, the landlord, so if I'm your landlord, you own a business, I have you write the check to the town of Chelmsford, not to me.
Right.
Then I can't write it off.
but I can.
Correct. But if I'm claiming that as income, I can then claim the check that I now write to the town of Chelmsford to pay for it. But you can too. But you claim it
We
under.
can both claim it?
Yes, but you would claim it under rent.
Right, because it's part of a
Correct.
customary or expected cost of normal cost of doing business, right?
Yes.
So, is there a strange situation where a landlord could do better under an increased property tax rate? Where if they're getting, they make whatever profit or loss they make from the building, and then they get hit with an increase in the property tax. They're able to pass it through to their renter, who gives them that amount exactly, that essentially pays for the taxes
Right.
that they have to pay, right?
Right.
So that's, it seems to me those two
don't think it would
balance.
benefit them, but it
then
won't
they get
hurt
to
them.
claim a larger deduction.
Yeah, but they're still, it's
nets
dollar
out.
for dollar. It nets out.
Zero effect.
Yeah.
Okay.
It doesn't,
Even though they're getting more income at the same time they're
they're
getting
getting
a
more
big-
income, but the
but they have to
exact
write
same
off the
amount of,
exact,
yeah, the exact same amount of money is going back out the door.
Okay.
Yeah, it's almost like they're acting like a clearinghouse.
I am a little confused with your
Please.
last comment, though, when you
Yes.
said that if the tenant could deduct the same tax expense.
So if the tenant pays the landlord an extra $2,000, for the up in the property tax, the tenant can then write that other $2,000
As a
off.
rent expense.
As a rent
Correct. All right,
expense.
I'm sorry, I get what you're saying now.
And
yeah.
then the landlord writes it off as a property tax. But they can they both write it off,
Yeah.
different lines,
Yeah.
but they both, as long as the landlord's claiming the income.
But the tenant's paying it, though, it's.
Right,
It's
that's why
still-
a lot
It's still
of,
money out of their pocket, but they can use it to shelter some of their other income.
Yes.
Right?
but, yeah,
But it's the same thing, though, it's you spend $1, you get, the
Well, they
tax.
get
tax.
66, they get 66 cents
Right.
back, right? Yeah, yeah, so they don't get to shelter at all.
Right.
But it's mitigated by essentially
they-
whatever the tax rate
They're
is.
paying 66%,
Right.
that's 66 cents instead of.
That's right, you get
100.
33 back,
Right.
right.
I lost you on that one.
Just
Explain
that,
that again.
a business that sees an increase in their property tax
Yeah,
doesn't suffer the full effect of the property tax increase,
okay.
because they can write it off as a business expense. But it's not as simple as saying they get that, they get that $2,000 right back in their pocket. It comes off of their income first, and then the profit is calculated, and that's
Okay.
what gets taxed, right? So they recoup some of it, and the rate
little.
at which they recoup it is basically whatever their
tax rate
their
is.
tax rate is. So we're working with 33 as kind of a standard
right, yeah,
number,
I
but
figured
it
it was
could be
easier
different
to-
if it were an S corp.
Correct, yeah.
That's why I
And-
say, if you just think about spending $1, you get 33 cents back. You're spending $1,
Yeah.
but you're only getting 33 cents back in your tax effects adjustment.
That's a business.
A
That's any-
corporation.
any-
That would be anybody.
Yeah, anybody. We're talking business rates right now, but if you spend $1 and you have a tax benefit of 33 cents, then
Does that include the homeowner too?
it's for any, if
Anybody.
you, yeah.
Okay.
That would, well, that's where, I think that's what Amina was talking about. Up till now, that would have been true of a homeowner as well. But
Now
now,
it's
with the
different.
cap,
Now it's
with the
different,
cap
right.
on property taxes, and also
yeah,
the
yeah,
increase,
right, right.
the increased deduction schedule, or the changed
The change of the
deduction
deductions, right.
schedules.
A lot of people won't even be writing off their property tax this year, or this upcoming year.
Evidently, I've heard, and I don't know how true this is, but we have buildings in this town which are empty. And they have been empty for years, and businesses moved out, and nobody's put anything in there. Now, if those buildings stay empty, how does the tax rate affect the people who own the buildings? But there's no businesses in them.
So they're not making any money.
You still have to pay the tax.
They still have to pay the tax.
Right, but how do they, is there a deduction for them, or is it the same as if it
Same
was?
as we just
Okay,
discussed, yep.
Okay, that's what I.
They just don't have the income to offset it.
Okay,
But the higher income you can generate from a building increases its value and increases its taxable income
Right.
to the town.
that's
So-
why I wondered if there was nothing in there, if it made how much of a difference, okay.
So if you had an S corporation or some other kind of pass-through, and if you're kind of running it, right, you pay yourself a salary, but there's also a business profit
Correct.
at the after everything's left over. I assume you can tweak those numbers if you're passing things through, so that the business might show a loss
Fifth on that one.
while you've been paid a salary.
Right.
Right,
Well,
so
it's not a
you're
matter of
getting- you're
tweaking. I
getting
mean,
a
yes,
cash
there
flow.
are ways to tweak the numbers, but normally what happens is if you're showing a profit, some clients will say, okay, well, I have this much money in the bank and I have this much profit on the books. I'm going to bonus my employees in December. So that will offset some of the profit. You can't you can't make, ethically, you can't make decisions like that to show a loss.
Okay.
But you can make decisions like that to show a smaller profit.
And presumably then an increase
But
in
there is-
property
but-
taxes would kind of run along those same lines,
Correct.
right? You could, depending on whether I guess it's all coming through your own personal income stream, is that it? Or
It
does
is. Well, so what
can
happens
the
is
profit
that
stay
the-
with the company and not get,
The profits stay with the company, and all the shareholders, depending on their percentages, are issued K-1 forms. And the K-1 form shows all the numbers that need to then be brought over to your personal return.
Okay.
And depending on what they are, if it's just income, it's brought over on a schedule each page too. If sometimes it includes capital gains because the business had sold some property or had investments. Sometimes it includes dividends and interest. Those are brought over to the appropriate dividend, interest, and capital gain lines on your personal return.
and that's done on an annual basis? There's nothing's retained at the end of the year under that form?
Yes.
Okay,
So you can't, for example, in a regular corporation, if you had a loss 3 years in a row and then you had a profit, you
Yeah.
would have a loss carryover that
Right,
you could offset. You don't have that with S corporations or pass-throughs. There is no loss
Okay,
carryover.
so it has to be accounted for at the end of the year?
Correct.
Okay, so in that sense, a change in the property tax would play out more immediately?
Yes.
With a pass-through?
That's what I was saying to
than it
Mary
would
too,
be
that
in
we're,
a-
yeah,
a
this
C
is
corp.
more about what's happening this year. Like, it has to happen in this year, when the property tax was owed.
Right,
The only time that in the 14 years I've done that they've allowed the rule about that to be sort of loosey-goosey was this past year. When we found out so late in the year that there was going to be a cap in 18, a lot of states said, okay, listen, we'll let you pay your property tax through, I know, some,
Yeah, prepay.
some states did all the way through June. Some states said, we'll let you do all of 18 now, we don't care. So they allowed that. That's the only time I've seen there be the ability to deduct stuff that was technically encumbered the next year.
okay. I guess the last thing is, what, if any, distinctions are there on a kind of a tax basis between an increase in a property tax for a business and an increase in raw material costs?
None.
Okay, from a tax
From a tax
perspective,
perspective,
those
there's no
two
difference.
things behave exactly the same.
Materials and yep,
If you have to pay an extra $2,000 because the price of gas goes up,
right.
that it looks exactly the same on your
I mean, it's a
year-end
different
form.
line, but as far as.
But where it
dollar for-
falls, like in the categories, the effect is the same.
The effect is the same.
Okay, any other questions?
Yeah, just back to Woburn and the
Yeah.
Rotary. So if I understood you correctly, businesses that participate in the Rotary aren't concerned about
I don't
tax-
know if they're
tax
concerned.
rate
No
or
one's ever
tax-
talked about it, you know?
Okay.
When we sit around and we talk about stuff, it's not a topic that's come up.
So if they're not concerned about the cost of doing business locally.
No, they're concerned about the cost of doing business, but no one
But-
complains that as a resident in Woburn, they pay a different tax rate as a business than as a business owner. Most of the people who are in the Rotary in Woburn own businesses or work for businesses in Woburn and live in
Well,
Woburn.
then they're getting the benefit on the residential side.
Right, but no one says, you know, I wish my business had the same rate. No, I've never heard that. Yeah, but again, like I've said, they've had a split tax rate for a very long
And do you
time.
know what the,
It's sort of, it's an is what it is kind of a thing at this point.
do you know what the split is? The
I
ratio?
don't, no. I haven't lived in Woburn in 8
And the
years.
reason I ask is, the reason I ask is it's not a tax, it's not a federal tax issue,
Right,
but if the commercial taxes go up, let's say, $1,000 over a period of time, that business, in order to pay their rent, needs to sell more goods or services.
Or sell them at a higher price?
or sell them at a higher price. right.
So while we're discussing tonight,
Well, it's like the
fe-
cost,
fe-
you talked
federal
about the cost
tax
of doing
returns.
business.
at some point, whether it appears as though the property owner has no concern what the tax rate is, because they can write it off.
Assuming they have people in the property.
And even if they don't, if they're a big business, like in Chelmsford, they may not care for some reason. They must be writing it off somehow.
Well, they can still write it off, but they don't have any income.
Understood.
Right,
So that's
yeah.
not a deal breaker for big business that chooses to keep their property empty.
That's an argument, yeah.
1.7.
And then we heard tonight that at least in Woburn, small businesses that pay rent, doesn't seem to be an issue. So to me, what's left is, well, is are businesses in Woburn selling more coffee than businesses in Chelmsford?
Right.
Or are they selling it at a higher cost?
Are they
per-
getting
per-
an extra
Right,
dollar a
and what's,
cup or something?
you know, and what's the breaking point? Every community has to have a, kind of a breaking point based upon the local rents and the local economy.
Yeah. I think
Woburn
that's-
is 1.75.
So it's maxed.
They're maxed out, yeah.
So they must be selling a lot of coffee, a lot of, I mean, that's,
Yeah.
Yeah.
I mean, but I will say I
the
drive through
income's
the
not
center of
higher.
town
The
every
income in
day.
Woburn is not higher than the income in Chelmsford.
I don't know.
Can't be by much.
It can't be by much.
Not by much, no.
Right.
But, they are a city, so things are run a little differently.
Cost of,
Yeah, but
Right.
they do have a lot of businesses. I
Yeah,
will
yeah.
say that,
Median household income is actually quite a bit lower.
that's what I thought.
Well, yeah, so they have there's a lot of low-income areas in Woburn that you don't have here in Chelmsford. They have a lot more businesses, though. I mean, you've got,
Yeah, but you still have like downtown.
we have a downtown, then you've got the, what's called the Four Corners area, as you're heading towards Lexington. You also have the areas you're heading towards Burlington, and then you have Washington Street, which is booming
Right.
with the
And
Cummings
and
Park.
it's never been hurt by that whole thing of a split
I don't
tax
see
rate.
it. I mean, I'm there, I don't see it. But they've never had a problem attracting businesses. I mean, you've got,
Yeah, along the highways, they,
you've
I
got
would expect that
93
they
and,
would.
and
Right.
and 128 right there, so.
Yeah.
And you're 15 minutes without traffic from Boston, assuming you go a little over the speed limit. And you have the train. The train comes right there.
Yeah, public
Big- that's a big
transportation.
Yep.
Yeah.
So if I could, your discussion about the Rotary, I think, is confusing the
Yeah,
issue a
I'm not
little
saying,
bit.
I'm not saying that people are saying, oh, I love this. I'm just saying, there's been no talk. Mike's
Well-
question was, have you heard people? I'm saying I haven't heard people.
I'm a Rotarian as well, and Chelmsford Rotarian, we don't talk about it. It's not, so Rotary is a service organization. We talk about, what's our next fundraiser, how are we gonna fix
That's
this,
a good
and,
point.
Yeah.
it's not
I mean, we
about,
talk about our businesses, but like I said, it's not a topic I've ever heard any other business owner talk about, to be honest with you. But I'm also not going around saying, hey, what do you think about a split tax rate? So that's what I was saying. The way I was trying to get that across was my answer to the question is, I don't ever hear businesses talking about it. That's not to say that they're happy with
They
it.
wouldn't be
That's not to say
talking.
that they don't
They just
talk about
wouldn't be a
it. It's just,
discussion
I
point.
haven't heard that.
Yeah.
Thank you for helping me clarify.
Yep.
I understand that, but it's never kept any new business
I don't
out of
know,
there.
I don't know about that. You would have to
That's-
talk to the
that's
Woburn
kinda what
Chamber of
we're-
Commerce.
Right, that's what we're kind of trying
Yeah.
to figure
Well,
out.
all right, then let me ask you this.
Mm-hmm.
New businesses that have never been in there before will still go in there because of the proximity of where,
I
of
would,
how
I
it
mean, I
is
would
to the
think so,
highways.
yeah.
Okay.
I would think
Okay.
so. I mean, I kept my business there, but that had to do with other factors. It's
Right,
where
some
the
of it
business
is-
had been for,
That's where your clientele is.
30 years, yeah.
Mhm.
so a lot of people don't like change. They're not gonna, unless it's really appealing, you're not gonna move someplace else.
Yeah, it's a little bit sticky.
Yep.
Helen, you had the split rate, ratios. Do you have the actual residential to commercial breakdown? I mean, it's gotta be significantly
again.
more than Chelmsford, I would think.
You would think.
Just a macro question, I guess, from my understanding. So in my mind, if if the residents had a $200 that they had to pay
I like
less,
Mm-hmm.
and it's not going to affect their returns, then
Right.
they would benefit more from that than if the businesses had a lower,
No,
so the
Yes.
residents would benefit
Yes.
more
because they would have,
than the
right.
businesses on the whole.
Because technically, if it's not going to, if it did affect them, they would have less of a deduction. But even if it did affect them, you're talking, it's $200.
Yeah.
In the grand scheme of a tax return, that's really not that much.
Right.
Because it's not $200 off your tax liability. It's $200 off your income.
But, and
If it was $200 off your tax liability, I'd be singing its praises right now. But we're talking off your income,
and that's important to people.
yeah.
Tom, you were asking about the CIP percentage of the levy,
Yeah,
right?
yeah, yeah.
For Woburn, 28.8%.
So it's 10% more
It's
or
pretty,
less?
that's pretty high
those
in the
the- are those the
universe
current
of
numbers?
That's what you would
CIP
expect.
The ones we
ratios.
got, yeah, FY '17.
Okay.
one of these charts is FY04, that's why I didn't know which one.
Thank you.
All right,
Which-
anything else for Amina?
And you said it was 28, it's interesting.
28.8, yeah.
2004, it was about 30%, CIP. Residential was 69 something, so.
All right, thank you very much.
Yes, thank you. Good job.
If we ever figure out what our exact question on the triple net lease is about, we will send
I'd
it
be
to
happy
you.
to,
But
if you have a question, if you want to email it to me, I can,
Well,
I'd be happy
I
to
think it's
respond.
just, it's interesting when you said, it depends on who's the check being written to.
Correct.
And I think that's kind of a local question. I've always understood triple net was that the tenant paid the taxes directly. But I
See, and I
guess it
have
really
clients that do-
matters
I have
in what
clients that do both.
directly to who.
I have actually one client who owns 4 buildings in downtown Woburn, and there he has tenants. This is probably the easiest way to explain it. He has tenants, and when they entered into the lease in 2006, he built in the taxes from '06 into their lease. So every quarter, he brings me his tax bills. I then create a bill for the tenant that shows, quarter one of '06 and how much it was, quarter one of, 18 and how much it was, the difference, and then they have to write my client a check for the difference because it's increased, obviously. It'd be nice if it went down, but it's not. So because it increases, but they pay it because he pays the taxes and makes sure they're getting paid on time. The tenant pays him because they don't always pay on time. Because there's for those.
Which might be more valuable to them than the tax write-off. That
Correct.
flexibility and.
Yeah. Yeah. I mean, they still write it off, just not as,
Right. Well, you're right, they can still write
they
it off
still write it
as
off,
rent.
just not
Okay.
under the
Okay.
line of property tax. It's part of their rent.
Can you deduct the expenses of serving on a committee in town?
That's a whole
Especially
different
if it's
conversation to have and not while we're televised. Yeah. Thank you
All
very
right,
much, everyone.
thank you
Thank you.
again. Okay. We will move along to committee member presentations. John, I think you have an update. I don't know if we have any printouts.
I
It
have
doesn't look like it.
4 things, and for the first one, I do have
Okay.
printout. Yeah, this is just an update from the numbers we were looking at last week. So everybody has a copy. And so when we were looking at these numbers last week, a lot of the focus was on the column compared to previous year, which shows that even if you have a split tax rate, people's tax bills are still going to go up most years. But then the sum of the increases in the tax rate for the 1.1 split was 2,333. For no split, it was 2,494, or a difference of $161. That is not the tax savings. I mean, if somebody looked at that number, they would have a right to say, well, why bother? But that's not the tax savings. So what I added was the new column tax savings, which show that even though your taxes are going up most years, because they're going up from a lower base, they're less than they would be if you didn't have the split tax rate year after year after year. And in general, the numbers go up. And so after 12 years, the total tax savings, and this number is not imaginary, $1,660. So that's something I think a lot of people in Chelmsford would say, yeah, that's worth bothering with.
Can I go back? This makes no sense to me. I mean, yeah, you can do that out. The point is, you're comparing each year what the split tax rate would bring you versus the flat tax rate would bring you. And so you tell the person, okay, this year you're going to save let's go to the bottom one, $161. And so now I'm average taxpayer. When I get my bill, I'm going to expect it to be $161 less than what I paid last year. And it's not. What were my calculations? How much higher is it? It's actually going to be $179 higher than what I paid last year. So what if it's lower than what it would be? I mean, my assumption is once a split tax rate is adopted, you're going to be going with it from year to year. And so the average homeowner is gonna get their bill and they're gonna compare it with what they paid the year before. Am I wrong?
No, I think that's exactly
Well,
right.
I said,
yes,
what I said
but-
last week was almost what you just said, is you're resetting the base by $200. And next year I'm going up. But the up includes a 200 downer.
Right. Right, that's what you're missing, Mary.
No.
You're
In
not?
absolute terms, your taxes are gonna go up every year.
Right,
Yes, they
nobody's
are.
denying
That's
that.
what you're gonna see, though.
Base.
Right,
I understand what you're saying, but you're not gonna see that on your
We've
tax bill.
lost sight of the fact that if 2020 you start with 200 less,
I don't
2021 is
disagree
still
with
going
this
to be
math, but
200
I think
less.
what,
But the point is, at the end of, as I did this, at the end of 12 years, at a flat tax rate, your bill will have gone up just under $2,500.
Yes.
On a, if it's, a split tax rate is introduced and maintained, and we're talking 1.1 split at this point, and maintained over 12 years, at the end of those 12 years, your tax bill will have gone up $2,300. So the difference
There's the
between a flat
$200.
rate,
Yes.
yes, is about the $200.
It's
Right.
$200.
Over 12
every
years.
year.
No, it's not.
Yes,
It's
it
over
is.
12
Yes,
years.
every
is.
year. Yes, it is.
Yes.
Reset the base.
Every year. Every year, your taxes are these amounts lower than it would be
Right.
if you did not have.
You did not have, that's right. I will agree with that.
Okay.
But you're not gonna have the flat tax rate, so you're not really gonna be saving it that year. It could be,
right, yeah.
I'm sorry, when you, the first year, yes, you're gonna save something. That next year,
It's not going to be obvious.
you can say, you're gonna save $106, or I'm gonna go to the last one, because the first year on this is a little bit different, because you don't have, the previous year is the flat tax rate. But you come down, you say, if the selectmen are saying, we're gonna put a split tax rate of 1.1, a shift, you're gonna save $161. If I have an average tax bill, when I get that average tax bill, and I'm gonna say, how does that compare with the year before? And I'm gonna say, where's my $161? It's $179 higher than what it is.
But
But
just because
but-
people are going to
right.
think about it wrong, we shouldn't reaffirm them thinking about it wrong by telling them that story. The story is that taxes will be $161 less than they would have been if we didn't have the
Right.
split tax rate. At the end of the 12 years, this person has paid a total of $1,660 less in
Less.
property taxes than they would have if we did not have the split
Right.
tax rate.
But the problem with that is that they would not understand it.
That's fine, they
Right,
may not
right.
understand
No,
it,
the
so we should
problem is
explain
they
it to
would
them.
understand
We
it.
should
Right,
explain it
that's
to them.
right, that's
And
right.
actually, you mentioned last week, could we have, Frank put this on their tax bill or something like that? I don't know what we could do,
No,
but
no.
I wasn't, but people should and can be informed.
I'm saying you can be informed about that. I'm saying, Mary, that the average person in Chelmsford would realize that over a 12-year period if they knew that there was a split tax rate. They would also understand that they would have been paying that much more if it was a single tax rate.
I'm looking simply at a flat tax rate, what's the bill at the beginning of this period? At the beginning of this period, according to the calculations, the average single-family tax bill with flat rate was $4,681. At the end of 12 years, a bill on the average single-family home with a 1.1 split is $7,114. That's a difference. That means that your taxes have increased $2,300 once you've adopted the split tax rate, whereas they would have increased $2,500 if you had kept the flat tax rate the whole time. To me, that says over 12 years, I've had a net savings of $200.
That's wrong. That's just
Yeah,
plain
you're
wrong.
not doing it right.
Let me ask you a
I'm
question.
sorry, I'm doing it the way it as meaning to me.
Let me ask you a question.
Wow.
Say you're given a choice. You can either get a one-time only $5,000 bonus from your employer, or you can get a $5,000 increase to your salary. Which one are you taking?
Depends on your retirement date.
You're gonna take the increase in your salary, but
Right, because every year after that, you're going to be bumped up from a higher level. Same principle. Bottom line, the person saved $1,660 that they didn't have to pay in taxes.
I'm personally okay with keeping both of them. I think they're two ways of looking at the same thing. I'm glad to see that you did it, but I think it's important that if we're going to sum the tax savings for the residents, we should also be summing the tax increases for the
But he did.
for the corporations.
did.
I know. I agree. And the only real mistake is to compare across categories. You know, you can't look at the 6655 increase on the business side and look at the 1660 savings on the residential side, right? If you're gonna say 1660, you have to say 19,922, and if you're gonna say 6655, you gotta say 2333.
Right.
As long as we do that, I think people can make their own decisions about what a better way to think about it is. I hear very clearly what you're saying, that if this is gonna be done as some kind of political approach, it's likely not to have that intended effect. If the intent is to put a little bit of money in people's pockets, then this suggests that it would put a little bit of money in people's pockets year over year at the cost of taking it out of the business pockets. But again, I think we all started at that point. We all understand that's the basic idea of having a split rate. So I think it's good to be able to quantify it a little bit.
Before I leave this sheet, just one other observation. Mary calculated the percentage change. This is right in between the two columns we were looking at, which I'm looking now at the 1.1 shift. And it shows the percentage change for the residential property and the percentage change for the commercial property, both around 50%. I'm not saying that would be the objective of a public policy, but it's actually an interesting result.
It is an interesting result that it's the 1.1 split that does that. If you look at the 1.3 and 1.5 splits, they're both more unbalanced. I agree that that's also an interesting way of thinking about what sort of an effect a split rate would have. The last thing is, and I don't have printouts of it tonight, I did take one more stab at the graph
yeah.
of this information. I put them both on the I put both sets of graphs on the same plot, and I did it twice. If you look at it, the upper one has a linear y-axis, but it's a well-known problem with plots that there's kind of a tyranny of big numbers when you look at things with different kind of orders of magnitude. So the plot below it is actually on a log scale that probably does a better job of showing trends. I think at some point we should pick one of those for inclusion along with this worksheet in the final report. I think this is a pretty good way of thinking about how a split rate might work. The other thing that I noticed, looking at the chart one more time, and Mary, I think you brought this up last time, we need not to have a single set value for the CIP property. We need to find a median value or something like that, because actually if you look at the curves, the residential tax bill pretty much goes up monotonically. The CIP bill increases and then kind of levels off and maybe even shows a slight decline right at the end. And I suspect what that's doing is reflecting the diminished purchasing power of $1 million in the CIP market in Chelmsford.
The point was when you're looking at single family values, they're reflecting the trends and changes and assessments up and down. When you're looking at $1 million business thing, that's not reflecting. I mean, and you could say that that's And I illustrated that with looking at my house and how my
Right.
house paralleled the change in this average single value assessment. Whereas a business, 1 million this year is maybe
Yeah, it may
higher
not
or
buy-
lower.
right,
And
right.
so that, it's meaningless in a sense.
I think we need
that
to, we
column.
need to make that change, but
I did get a chance to watch the July 31st meeting from up in Maine, I'll have you know. One of the things I think we want to do is identify a specific, just like you did frankly with your property, identify maybe another $1 million commercial property, backtrack it, what it was, 10 or 12 years from what the assessment was, then track it forward, build it into that spreadsheet. I
Yeah.
think that might give you what you're looking for.
It gives you a better idea.
It will, assuming that, you know, and I have a couple buildings in mind, I'll make sure there are no, you know, nothing out of the ordinary happen with them in terms of.
I use the 12 years, Frank, because that's what you sent me on the
Yep,
history
exactly.
of
Right.
Yep.
valuations.
Yeah, that's fine, no problem.
So, but that makes more sense, and as I say, the average single value property is changing from year to year. But
Right.
$1 million is
Right,
not too many people have had the same valuation over 12 years.
that's right. And it's true with commercial properties, and this will show that.
Yeah.
Yep, no problem.
Thank you, that would be helpful.
Okay, that was the first one. The second one, I do not have a handout for this one tonight because for now I'm trying to preserve anonymity of property owners. So last week, Mike did a very nice job of presenting the residential exemption. I think it was actually an audition for a job with the assessor's office. He did.
let's just belay that right now, okay?
But one of the things that I pointed out was that the tax bill for the average apartment building would go up by a little over $7,000, but there is no average residential building. So what I did was, in a very non-scientific way, I identified 16 rental properties that would not qualify for the residential exemption. I found out how many units they have, what their assessed value is, used the tax scenario spreadsheet to figure out what their property taxes would have been, and then what they would be with the residential exemption applied. As Dan pointed out last week, it makes a big difference how many units there are, so I factored that in. And so what I ended up with was a increase per unit for each of these 16 properties, which include condos, single-family homes, duplexes, small apartment buildings, larger apartment buildings, all rental properties. The differences vary dramatically from a low of a $183 per unit increase with a residential exemption. That was for what I would call a low-end apartment building. Again, anonymity is important here. And the high was actually $1,236 for what I guess I might describe as maybe not a high-end, but a pretty fairly high-end townhouse condominium.
That's per unit.
That's per unit. The average per unit was $350 increase with the residential exemption. That's of these.
That's with the 20%?
15% residential
15%,
exemption.
right, whatever we worked with, right.
Yeah, whatever we work with. So I'll send you the spreadsheet and you can decide what to do with it. Okay, third. Mike mentioned this in his email. I had an opportunity to meet with Rob Anderson, the Community Development Director for Barica. Evan has always told me, anytime you have a chance to meet with a Community Development Director, take him up on it. And this is just a reporting on what Rob had to say, which I would be glad to attempt to answer any questions have, but I don't really have much else to say. I guess other than the following. I'm looking at the member of the Board of Selectmen here tonight. The last paragraph says, Rob Anderson finished with this parting and rhetorical question that a mentor asked him multiple times. Quote, how can a community say they are business friendly if they have a split tax rate? If the Board of Selectmen so choose to have a split tax rate, I think you better be prepared to answer that question. How can a community say they are business friendly if they have a split tax rate? But don't worry, I have an answer for you, but I'm not sharing it right now.
Oh, I have an answer.
Okay.
And it's another rhetorical question, because the great thing about rhetorical questions is they're really hard to answer. And my response would be that how can a community say they're resident friendly if they don't have a split rate?
That was part of my,
I think it depends on how you understand what a split rate is supposed to be doing. If you see the 1.0 rate as somehow a natural baseline, then any deviation from that 1.0 looks unusual and unfriendly. If you see the range of 1.0 to 1.5 as kind of the normal inhabited range, then actually a 1.0 looks a little bit unnatural. It looks like you're way over at one extreme. And I think that is maybe the question really that the selectmen are gonna have to answer. I mean, whether you pick 1.0 or 1.1 or whatever, what do you say to the residents? What do you say to the business community? Once again, I'm glad we're meeting on Tuesdays and not Mondays here, because that's a tricky question. But I don't think it's a simple black and white.
Do you know how long Billbrook has had their split tax rate?
as far back as I could find.
If
Like
they're-
for instance, 87.
They're a
at least.
1.75, and I think if you're a 1.75, you've had it at least since 2004, right? Or that was when they allowed the increase
That was
there.
the increase, and, let me see, the split, I think it was, the tax classification was 1978. 1978 was when classification was first allowed, with a maximum of 1.5 at the time.
They've had it since as long as I can recall, and they even took advantage of the Act of 2004, in which they went up to 200%,
Right.
with the understanding that they would back off whatever the percentage was down to get it down to 175. So they've had it as long as I can remember.
Okay, and one final thing, the chair said I could do this. I'm looking again at the member of the Board of Selectmen here tonight. Can I ask you a question?
Well, you can ask. There's no promised answer.
Okay,
That's
no,
okay.
Here's a question. So I was looking at the 2019 goals for the Board of Selectmen and Town Manager. And one of the goals is work with the Council on Aging towards becoming an age-friendly community. So not knowing what that meant and wondering if that meant we were an age-unfriendly community, Evan explained this to me. So apparently there's the American Association of Retired People have this program where communities can, I guess, earn the designation of a age-friendly community. And they actually have a checklist that they borrowed or stole from the World Health Organization. One of the items on that checklist, which you're supposed to achieve if you're going to be an age-friendly community, sufficient affordable housing is available in areas that are safe and close to services in the rest of the community. Do you think we can check that one off? No. I'm done here.
Okay. Helen, did? Yeah.
I did not talk to Rob.
Oh,
at
you
all.
didn't talk to
I did
Rob.
not talk to
Okay.
him. I wanted to know, my question to you was, did I have permission to contact Rob? And the other individual was Tim Cummings, who's Director of Economic Development in Nashua, who had done a lot of work in Massachusetts, and both of them had worked, and I don't remember the title of what it was, but somewhere in Boston, they were on the same.
Mhm.
They
They
worked
did.
for what?
Okay. So I think we can have, it's appropriate to have a discussion about this. I mean, if there's a feeling that we should have somebody in who's worked in a classified town, then Mr. Anderson might be a possibility. We've got the fellow for Leominster
Yep, they're not
coming in,
classified.
who's not classified, but he did work with.
Yep, Sturbridge, where I
Sturbridge,
think
right?
they were, yep.
Do you happen to know if they were classified while he was there?
I don't.
Okay.
He'll,
Yeah. Well, I think we'll have him come in anyway, right? And hear what he has to say. And is there a sense that we should reach out to either Rob Anderson or actually I had a suggestion as well, Peter Milano, yeah? Right, the state board. Evan also had proposed the Worcester Research Institute, is that it?
BRO.
Okay, had offered to send a speaker out as well sometime in September, I believe, right? Or that was Peter, was sometime in September. I guess we can do this under this heading, but is there? Sure.
Robinson was the director in Marlborough, which was Chelmsford in 2004. And Marlborough was considered the poster child for.
Okay. I mean, is it the sense of the committee that we should reach out to one or more of these people?
What are they gonna bring to us?
Well, I think that's,
Information.
Pardon?
that's,
Well, what information?
well, that's
Well,
a
until they
good
come, we
question.
won't know.
I mean, we've heard from Chelmsford's
Yeah.
economic development team. I think there's an argument to be made that somebody who's worked in a classified town might have a perspective on what the special challenges are. Beyond that, I think you'll probably hear more talk about what's important with economic development. And that's why I want to bring it forward to the committee as a whole,
Okay, right.
because is there a sense that we've kind of heard these things? We've got a number of reports. We've heard from the people closest to the facts on the ground, the Chelmsford team.
One of the things, I mean, for example, reading this conversation about Bill Ricca and what Amina's comments tonight, et cetera.
Yep.
It seems to not be affecting the business development or community or whatever in these places who have had the split tax rate for a long period of time. I might like to hear from someone who was present at the, at a point in time when it was introduced in the community. If there's somebody who's recently adopted classification.
Isn't that Rob Anderson?
and-
That's Rob Anderson.
No, well, not in the
Didn't he
sense that they've
do-
recently developed,
mean,
or recently adopted it in Bill Ricca, but Sturbridge might be a case.
I mean, I think to know how that affected the businesses, what the reactions were, et cetera, I'd like to,
Marlborough was not 175.
Right, he wasn't when he was doing it, it was a single tax rate, and then it went to a double, and he built it up.
While he was the director?
Yes.
Oh, well,
well, then,
yeah, okay.
that's what I'm, yeah.
Yeah, because Marlborough is really built up from
Right.
what it was in
I-
2004.
I get this sense that communities that have been doing this for a long time, it's accepted, and it's the
It's
way it is.
just part of the lay of the land,
It's the way
yeah.
it is. But when you're making that change,
Yeah,
I'd like to get some more input on that particular.
And we need to be comparing apples to apples. I don't agree, I understand Woburn and their insensitivity to the split rate, but it's not the same town as Chelmsford. It's a completely different animal. So that's one of the reasons why I wanted the gentleman from Leominster to show up. It's a similar
Okay,
town in terms of the business and residential mix and being a suburb to a city, a bigger city. And, I think we need to be just comparing apples and apples. And when you start talking about Woburn and Billerica, they're different animals, they really are.
Tom,
So,
I don't see how you correlate Chelmsford and Leominster.
I don't either.
just in terms of, I believe, population size, but residential and business mix, it's similar.
Sorry.
Again, it's a suburb to a bigger city, like we are to Lowell.
But I don't
Okay.
think the roads
They're
are the
next to
same as
Fitchburg.
ours, are they? I
They're-
mean, they don't have the same benefit of highways, do they?
They
I
got
don't
Route
think-
2, I mean, it's,
Yeah, but Route 2 is way out in the middle
Well,
of nowhere.
but you can split hairs down to whatever level you want. The point is Woburn's far from Chelmsford.
Yeah.
That's
No,
right.
I'm not,
So
don't,
I
I'm not
just-
telling
we
you
gotta-
not
We gotta
to.
find similar towns to look at, that's all.
How
you
does
know.
But I'm
Marlboro
saying is
fit
not-
in?
Marlboro might be, I don't know.
I think that's a
I
good-
don't know, I didn't look at Marlboro. We probably should look at these charts and try to hone in on a couple of towns that are more like us.
'Cause
Whether they
I-
have classification or not, if they do, it'd be good to hear that. I would like to hear that.
yeah, I am kind of with Mary. I want to hear about the challenges. If it's there and it's working, that's one sort of interesting, but how to make it work is a different sort of interesting. That's much more interesting, and to understand what kind of problems you might have as something like that gets put in.
And I think my comments about it's been there for a long time just have to do with people getting used to the way, the way it is. Whether the communities are the same or different, I hear what you're saying, and I agree finding out about it there, but I think there's a certain, this is the way it is, and we accept it. We want to do business here, we accept it.
And if you want to live here, they can't. So there's another, you've got the opposite side there. I mean, no offense, but, because I don't know how I would go yet. I really don't anymore. But that's why I was thinking in Billerica, because he was in Marlboro, and
I think
it was single and then went double, and he built it up. That's the kind of person I want to hear from.
Yeah, I think that would be extremely valuable.
I can tell you, I have customers in Billerica, and when I analyze their rental streams, I am blown away by the taxes they pay. It is unbelievable. I don't understand why anybody would buy real estate in Billerica, commercial real estate. But my perspective as a banker, I don't do a lot of business there, and a lot of the guys that I do business with there, they struggle keeping their properties rented because it's just too expensive. So, I mean, if you're okay with having, commercial properties vacant and
Yeah, but I'm asking, please understand, I'm not asking because he's in Billerica. I'm asking because he was in
yeah,
Marlboro before, that's all I'm asking.
that's,
That part of it, not so much,
I just find the
What you're
Billerica
saying.
comparison kind of interesting because there's a lot more going on there that this doesn't say. He kind of says it actually, but,
I think it's worth bringing in all of these subject matter experts. But I would say that in the context of one meeting, maybe 2 meetings, understanding that the timeline is,
The
Getting
timeline
tight.
is starting to get short.
and I
yes.
think,
that one
I
meeting.
think while we may learn about other town-specific scenarios, I'm not sure that we're gonna be able to take those lessons learned and apply them directly to Chelmsford. I mean, what I've learned in sitting here is that trends are nice, and that's where I started, but there's too many variables and what-if scenarios to have any data methodology to apply to projecting the outcomes. You can kind of do a trends analysis,
Right.
but then you can do that for Chelmsford, but then to take what happened in another community and try to apply it,
Yeah.
it just doesn't work.
I think what we heard from Amina tonight was that even on an individual level,
Right.
there are just so many variables going on. And I think the same thing applies if you look at it
That's
on a town-by-town case.
That's
There
why
are also
I like
special
the things that John's been doing, because they're very Chelmsford specific.
Yeah.
And I think the more data we can, and analyze that's Chelmsford specific, and then make some projections or calculations, I think the better informed we'll be.
Well, do you want to reach out to Mr. Anderson then and see if he's got time to
I
come?
can, or do you want to, John, since you've already talked to him? It's up to, it's up to either one of us.
I'd be glad to do it, but I think you're the one who's actually requesting in some sense that he
Okay.
come. I think it'd probably be better if you did it.
Okay,
But again, I'd be glad to do it if you decide you want to go that route.
I think we'd target the 21st.
okay.
If he can't do the 21st, I guess, the 14th is starting to fill up a little bit.
Yeah.
But the 28th is the public input session. So let's see if he can do, he'd be the main event on the 21st. The 14th, though, I think I'd rather have him here.
You want him on the
rather than wait-
14th?
Yeah, rather than waiting into September. If he's not available until September, then, we can talk about that too, right? I mean, it does sound like he'd have a particular perspective on things that would be useful to hear. So we'll work with him, but the 21st would be ideal, I think.
Okay. I will call tomorrow.
So did we want to back off the Worcester one?
I would
Well,
love to
so
Wednesday.
I'm thinking if they want to come, again, so maybe you can just talk about that a little bit, who they are. and-
Yeah, so, the last meeting I was at, I had mentioned that, I've come across state studies and some national studies. Few and far between. There's certainly not a lot of research out there. The Massachusetts, the Worcester Research Bureau seems to be probably the most published on the subject matter. It's Worcester-centric, but one of their publications indicates that they analyzed all 351 communities for a similar trend. So that's why I keyed in on that. So there are, it's a high-level study, but it's one of the few that exist in Massachusetts. I think the benefit that they could bring to us is high-level trends analysis, but not specific to Chelmsford. I'm beginning to think that maybe focusing on Billerica and Leominster may be more beneficial to the committee itself, and maybe distribute the study.
Yeah, maybe
the
we
Worcester study.
should do that first. If they're not, but you reached out to them, and they indicated they could send somebody out in September.
Well, I asked him to confirm whether he could come in August 14th, which he could, but he could probably, I figured the time was of the essence.
Yeah.
He indicated that he would do probably no more than a 10-minute presentation. I mean, yeah, we could technically fit all three in for the 14th. I just don't know if the Worcester one would be as beneficial as the Billerica and Leominster one.
Well, it would be another perspective.
Yeah, it's a different, yeah. So if time permits it,
And for, a 10-minute presentation, and it's probably going to be another 10 or 15 minutes of questions,
all right,
which is
no
fine,
harm
right?
done.
Like,
different
Yeah.
perspective, and if nothing comes of it.
all right, so yeah, why don't you reach out, and I will circulate the study that Evan sent to me as well. So maybe you can get a look at it and just see what they're talking about.
Are we on upcoming meeting dates and topics? Is that-
Well,
is that what we're on?
some of the presentations have led into that. Yes.
There should be a letter from the Chelmsford Housing Authority by next week, but we can always, it won't take long, or we can hold it off until the following meeting.
What is that going to be about?
Just, I asked the Chelmsford Housing Authority to provide some input. They're not going to take any positions on the policies, they're just going to provide
right.
some input, whatever David Hedison decides he wants to say.
They'll give you the right information.
Yeah, and if we have follow-up questions,
Yeah.
I'm sure we can do that too, and, we can chew it to pieces ourselves.
I have no doubt what he produces will be factual.
Exactly, yeah.
Right.
Okay.
Okay, any other presentations or questions?
So, just to understand the agenda here, are the questions to pertain to today's presentations? or
No,
can
pretty
we-
much, this is supposed to be kind of wide open and
Okay.
and a catch-all.
So then I have a
Okay, good.
question. A couple weeks ago, we heard from Mr. Diggs at the end of one of our meetings about how he felt that the split rate system, really is designed for situations like what we have today. We had talked about commercial values not increasing as quickly as residential values. And I heard that, and in my mind, I thought, well, that's an interesting perspective. But at the end of the day, my understanding of taxation, public taxation with levies, is it's a simple denominator, numerator equation. If the values go up, then the numerator goes down, and vice versa. So it's not necessarily a valuation issue, it's more of a levy issue. The levy is what the levy is, and if it's a flat rate, you divide it out by the valuation, by the number of units, and there you go. So in a situation where the valuations are going up, your tax rate goes down, and when valuations go down, your tax rate goes up. I was wondering if, Frank, if you might want to pontificate a little bit on that notion and explain maybe in clearer terms.
Tom, I've tried to make the calculation of the tax rate a confusing and convoluted thing.
Thank you.
Unfortunately, you've just simplified it. That's essentially it. The levy is simply divided by the full and fair cash value of the town, generating a single tax rate. With a split tax rate, as you know, we offset the CIP to reflect the percentage we want, and the calculation is much the same way. The split rate, as Sam, I think, mentioned several weeks ago, was originally incorporated once, because the valuations, when it was incorporated, were so out of whack, that incorporating full and fair cash value for the first year was going to be such a dramatic shift that it would have been really damage the residential part of it. The split rate was a way to try and strike a balance to that. The intent of it at the time was probably to, over time, to get rid of the split rate, but it became as the report, the DOR report says, it became eventually a political tool that's since found its way and is really not going anywhere anytime soon. So now it's been implemented as a part of the whole tax classification presentation. I don't know if that explains it at all.
Yeah, no, thank you. I needed to hear it from you, and thank you. That's all I have.
Okay, that's fine.
That's it.
Anybody else? Questions, comments, thoughts?
I always ask this question in most committees I've served on. Listening to the young lady tonight, and this not unexpected enormous confusion in the taxes of 2018. Why is it so sacred for us to have a position for the Board of Selectmen this year?
Are you asking why it has to happen this year?
Yes.
Or as opposed to next year or the year after that?
Right.
Speaking for myself, I hope the report we put out does form the basis for their deliberations, not only for this year, but for subsequent years. That we're able to lay out the major threads, the major concepts of the argument over split rates, and split rates in the large sense, a split between residential and CIP, the split amongst the residential rates if you use a residential exemption, the split amongst the commercial rates if you use the small business or the small commercial exemption. I think that's what we've been asked to do, to kind of provide them with a summary of the argument, and every year they'll have to come up with an answer to that argument amongst themselves. But I would hope that this goes beyond this year, that we don't get bogged down in what's going to happen just in 2019, but give them some guidance on how to go forward with this.
Some people are still using 1994
I think
tax
it's so
rate.
confusing that I'm not sure I'm ready to vote
Well,
in another 2 or 3 months.
We don't have 2 or 3 months.
But the thing is, my understanding is we're not voting on one specific item, we're giving the Board of Selectmen recommendations and, indicating if this happens, this will be the result, and if this happens, that will be the result. So it's, in a way, it's fostering their thought process.
I'm hopeful, that we'll
How
be
they
able
feel.
to have some factual sections.
Right.
If this, then this.
Right.
That then can maybe be supplemented with recommendations. And we'll have to see how these recommendations go. Again, back in the early meetings, we talked about unanimous recommendations. And I think it's clear there's not going to be any unanimity here. So we do need to talk a little bit about what a recommendation would look like. Because I've gone back and forth on this. I don't want this just to become an exercise in political power. But I also think we're sitting here, we're going pretty deeply into this stuff, and in a sense, we'd be not doing the job to the best of our ability not to express some opinions. The question is, how do we express those opinions as a whole in a way that allows for people who come to this late, people who read this report 2-3 years from now, to understand there are legitimately opposing viewpoints on a single issue.
Can I just respond? As an example, it's certainly possible that in our final report, there could be the case against doing it this year because of the complexities that you identified. That could be a valid argument. Then there could be a different argument that would say, well, maybe this would be the best year for some other reason. And we could cite both of those factors and let the Board of Selectmen figure out which one of those is more compelling.
Yeah. Yeah, I think we'll talk about this a little bit more as we move into September. But, kind of my inclination now would be to have, if the section is the residential exemption, to have a page or two that explains what the residential exemption is, how it works. And then we'll put it up as a motion, resolved that the 20% residential exemption should be imposed in Chelmsford. Let people vote on it, and then let somebody from the pro side write a paragraph about why they think it's a good idea, and have somebody from the con side write another paragraph about why it's a bad idea. And without any real restrictions on, is it a good idea this year or not a good idea next year? Just, whoever feels strongly about it, if you can make a case succinctly one way or another, that's where my head is right now. Again, I'm perfectly happy to listen to other thoughts.
I also would like to look at it from a different perspective, so far as, we've mentioned this before, and this is one reason why I thought we were here, is to educate the people in town so that they can look at our recommendations and understand why we're saying this.
Mhm.
And so we have to get rid of some of the complexities in our words that we use, I think, because a lot of the data is very complex, and I'm sure there's going to be data there. So depending upon where you are and what you understand, I think we need to have an overall understanding as to what we're recommending.
Mhm.
Because there's going to be people that are going to be very upset with some of our recommendations. And when they are, I want to be able to point out to them why, so that the recommendations need to be very clear.
Mhm.
So that's where I'm coming from too. It's very important for the public to understand why we're thinking this way.
Relative to your pro and con or whatever, I guess what I saw coming out of it is more, talk about residential exemption, explain it, then explain who it helps, who it hurts.
Yeah.
Right.
In a more general way. Let's forget about
And stay
specific
away from
levels,
the-
for specific levels, but you do a residential exemption, higher property value people will pay more.
We'll pay more, right. And we can put a number on that. I mean, we
we
can
can
say
put a
how
number.
much more they'll pay. Yeah, the question is, do we need to go beyond the charts and the tables with kind of a pro or con?
And you do the same with the small business
Yep,
exemption.
right.
This is the kind of people it helps, this is the kind of people it hurts. And maybe some examples of how much, but I don't think
Mm-hmm.
making a recommendation or something and giving pro and cons. I think when you give these, this is who it helps, it hurts, you're giving
Right.
the pros and cons.
I
Okay.
agree, Mary.
Okay. Well, we have weeks to get this figured out. Evan, something that Mary said reminded me, I had a question for you. I was looking through the master plan the other day, and the master plan had a breakdown of businesses by size.
Mhm.
They were comparing 1994 to 2009. Is that something, the work was credited to the Economic Development Office, I think, but also to an outside research group? Is that the sort of thing we produce, that the town produces?
So it's not town-produced, it's primarily pulled from the census data. The
Okay.
question is whether that particular census table was updated as part of the community survey. I doubt it.
Okay. Is that something that's done annually, or just every time somebody writes a master plan?
So the census data is every 10 years.
But
So
the
that's-
American Community Survey is updated
Yeah,
every year,
so-
but you're right, I don't think it has much at all
Correct.
with respect to.
Correct. So we can, there's a couple other sources, Department of Revenue may have.
Right, they
some
break
more
it, they'll
updated.
break it down by, big, employers with greater than 500, 250 to 499,
Yeah, the
that
master
sort of
plan was a
thing.
bit more,
It was a little more granular.
yeah.
And just when we talked about trying to understand, just as, on the residential side, there are going to be people that $200 means something to and people that don't. We kind of have some sense of that breakdown. On the commercial side, there's going to be that same problem, right? Like the bigger C corps who can hold these things through until they get some profits to shelter probably don't care the same way an S corp that has to clear its books at the end of the year cares about an increase in a tax rate. So I'm wondering if that's the sort of statistic we could use to kind of get a sense of the lay of the land here.
So you're looking for a breakdown in total revenue? Is that what's the?
More, well, I mean, I
What
think,
is the data
first of
point?
all, more or less than 10 employees
Yep,
and some kind of breakdown of, between 100 and 500. The schools are the biggest employer in town. They're the only one with over 500 people, I think, at this point. So
yeah, I mean, I
But
think.
it would be nice to see if there were trends year over year as well.
If that or not.
If
Yep.
there's been a shift away from bigger companies to smaller ones, is that who Chelmsford has become or is becoming, that sort of thing?
Okay. Was there also a separate data point related to, you asked about the types of, not the size, but the type?
That, I can't find that information anywhere from the state. I mean, I'm not sure where to look, to tell you the truth. But
What are you
DOR doesn't
looking
seem
for?
to,
Looking for total revenue or?
anything
the-
really. I'm having a hard time finding much commercial information.
Yeah, I mean, I can,
Residential is one thing, but
yeah, I can tell you that of the about 1,200 businesses that are in town, 350 of those are located on 129. There's about 200 or so that are home occupations. I mean, that's, very rough and high level.
Right.
Even that information wasn't even in the master plan.
right.
The 350 on 129 is something that, once Lisa started, we were able to track that number down.
That's a big number.
That is
Yeah,
a
but
big
it ranges, the small businesses there, print shops that have
I
10 people.
I
and-
can't, in my head, I can't fathom 350 businesses.
It is-
You're talking from like the cemetery
Um,
down kind of thing?
Yeah, and then down the side streets,
Yeah,
it's
yeah.
4.7 million square feet.
Jeez, that's
So-
amazing.
Yeah. Well, the state puts together a list of small commercial exemption eligible companies, I believe. But as Frank said, that may not be complete and whole.
So what I can do is, NIMCOG helped us with the master plan. I will send a request for updated business size by employee,
Yeah, if they had that, that'd be great.
as well as something related to business types, either by revenue. I know they can do it by industry sector, but I'm not sure that's going to be of any help.
Yeah, you can get that breakdown, and you can even cross that to individual companies. It's
Yep.
just that anything outside of the agricultural sector, which has, I think, 4 businesses in town,
Exactly.
becomes a becomes a very time-consuming
Yep.
thing.
All right, I'll make those requests.
Thank you.
I have a question about the relativity of, you had mentioned that the education system in town is the largest employer. Is there any relativity to how many people in the educational system actually live in town? And then also how many people that are hired, by the town live in town? Does that,
We could probably we could probably get those numbers either from the school department or from the town offices. Neither one has a requirement that you live in town.
right?
I'm just curious, how do you see that affecting tax rates?
Well, people want to come to this town partially primarily because of the schools. So if most of the employees at the schools lived in Chelmsford, I think that would be an intrinsic motivation for a family to want to improve the educational system. If you live in town, you want to be part of a system, be part of a town that excels.
I don't dispute that, Sheila. I just wonder what that has to do with the tax rate.
Well, looking at the residential rate, higher or lower, but maybe that's my question.
You may be speaking to newcomers opposed to people who've been in town of
Yeah.
30-plus years. I agree, if you're a first-time home purchaser,
Uh-huh,
you may be more inclined to accept higher taxes with the understanding that it's improving the school system, which may or may not be true or be factual. Well, if you've been here 30-plus years and you helped build the community,
Mm.
you may feel as though time for relief.
Good point.
But the beauty of Chelmsford and the strength has always been as a bedroom community in our diversity of our housing stock, which has provided a good spectrum of newcomers and people who have been here a long, long time.
But we're also seeing a lot more leaving and a lot more not coming because of our tax rate for individuals. And that's the part that I see as scary, especially with the elderly, which is less of a tax burden on the schools. And yet it's something that
Yeah.
puts money into the town that is an advantage to the town.
I think it's an interesting conversation. I agree with Mary. I'm not sure it's directly related.
Well, I think it's very related.
But I'm not sure the town is having any difficulty attracting
Yeah.
first-time home buyers.
From what I'm understanding,
think that-
home prices are rising and
Yeah.
houses are going like that.
You can think of it this
That's the
way,
problem attracting
Helen.
first-time home buyers.
Helen, I gotta say this, because you say this, you're talking, this is a sore spot with you, and I don't disagree with you, because, I think, I'm a native of this town. There's gonna be a point where I'm gonna be questioning whether or not I can afford to live here anymore. It's a
Well,
fact.
those are the people that I see leaving our
Correct,
community.
but that's kind of the natural progression of life, right? But let me just say this.
Yeah.
This is the carrot at the end, that's dangling in front of you. Your taxes are going up, we're maintaining a good government, good school systems, yada, yada, yada. Your values are going up, so you got a windfall. When you sell that house, you got a windfall of cash that's gonna be, deposited into your bank account. So
Right.
you're paying taxes. Let me put it to you this way. Would you rather have lower property values? Would you rather have your house be worth less? I don't think anybody would say no.
Absolutely not.
Right,
What
right.
I
But it's a
am
function
saying-
of taxation
But what I
and,
am saying, and what I see and where I am, and I know that nobody likes it, but what I do see is that the people coming in have sold houses for $1 million someplace else, and they're coming in and they're pushing out the people that have been here for years. And those are the people who cannot stay.
I can tell you, I went to the school system here. I have a handful of friends that still
But
live
you're
here.
not a
Everybody moves on.
retiree.
It's just the
No.
natural progression. I mean,
I think
not
that
everybody
there,
stays in Chelmsford.
I think,
But
I
ev- but
think
every-
that solution is what John was referring to as the age-friendly community. And Selectman
Right.
Diggs mentioned, and I think the Housing Advisory Board agrees, is that the town needs to focus on providing more housing opportunities for its aging population who can sell or downsize but have an affordable option. So there's still work to be done, which I think we can do separate from classification. And maybe it helps solve if you can go to a smaller house that costs less to maintain and operate.
unfortunately, right, I agree.
There's that thing
I
called
agree.
downsizing too, I mean.
Yeah, that's the challenge.
it's-
Chelmsford
Well,
doesn't have those
unfortunately,
options.
now if you downsize in Chelmsford, and I've seen this, if you can go to the Westlands, that house is as expensive as Meadowwood, yet Meadowwood has a much better home and is easier for an elderly person to live in. That's where you've got to take your thinking and think about how we're going to do it for the retirees. And that's something that I think is part of the tax.
I don't think that's just a problem for this town, though. I think it's
Well,
a
it's
graying
not,
of
and
America,
it's not.
where the population is just getting older. It's a national issue. It's not just a local issue.
No, I don't think it's just a local issue, but we're only
What do you
working
think
on
about
this
the
one.
towns where they're selling the $1 million homes and moving here? What are they talking about when it comes to senior housing?
Well, their taxes are lower, but what they're saying to us when they come in is that we have the money to pay the taxes. It's the people who were here before who don't have that money. And that's the part that I think we're missing in this equation. And if you've had a house for 30 or 40 years, it's a different story than if you're trying to downsize because that house is too big. Maybe I'm wrong, I don't know. I just
I don't
see
think
that that
you
is.
can help this cycle by splitting a tax rate. I just don't see where that
Maybe
breaks
not.
the.
It's a
that breaks-
combination.
Well, it depends
Providing
on-
more housing opportunities.
It
And-
depends on where you split it. The
Yeah.
split may need to occur in the residential sector instead of between the residential and the CIP sector, right? I mean, that's what the residential exemption proposes to do, is basically split the rate within the residential section of town.
Yeah, that's
Um,
true.
So I think there are a lot of things to look at, and there are a number of strategies to
Right.
be considered.
And please understand, I'm not 100% that we need to split this at this point. I think we need to get more information, and not more charts for me.
Please
I need more
understand, I'd love to
information.
see our taxes go down.
Right,
I
right.
don't think
And
there's
I don't
anybody
want
in
the
this
value of
room
my-
that wouldn't rather
Right.
pay lower taxes.
And I don't want the value of my house to go down either, so, I mean, I agree with that, but I'm saying that that's something that I would like us to think about too when we're doing all of this.
I'm fine with the fees that I pay for a civil society.
Okay. I'm perfectly happy to let him have the last word on that one. I kind of agree with that. Is there anything else, questions, comments, upcoming meetings, which we did kind of bleed into?
What are we doing on the 28th?
Public input here with the door open if we need
Are we
it.
doing, is the primary purpose to do public presentation? Or are we just
Well,
doing public
you know what, that's a
input?
really good question. I had been thinking about it mostly as a listening experience. However,
I thought we needed to give them some information to
Okay.
think about.
Don't you think from experience that it's more beneficial if you ask somebody a question and you're looking for an answer, as opposed to just saying, we're here to listen, what do you have to say?
Because don't you think they're going to get up and say, I want lower
I've had a
taxes?
variety of experiences with public input sessions.
Yeah, you have.
I think.
Well, so one of the challenges with putting a presentation on is what do we talk about?
Agreed, yeah.
So I think at a minimum, we need to talk about a split rate between residential and CIP. I think we should also do a brief overview of the residential exemption as well. I think we are not going to have heard anything from Westford by that time. So, and if the point is to talk to residents, I think the small commercial exemption does not necessarily need to be part of the presentation. Do we want to do a summary of the exemptions as well?
Yes.
Okay?
Why are we assuming that small businesses or business in general might not, they may show up too?
Particularly if we notify them.
Well,
that
you know what, you're not wrong about that. On the other hand, we're not going to have done any work on the small commercial exemption before
If
then.
you're explaining how things work,
Well,
you can explain how it
I mean,
works.
Frank has already done a lot of work on how these things work.
Right, this is not, yeah, Frank's not holding an open house, we are.
No, what I'm saying
mean-
is, we can just give a overview of what we got from Frank.
Well, if we're gonna do that, we need to be starting on that, because again, to Sheila's point, not everybody has been watching every meeting, and we may have to fine tune this message a little bit. It's probably not a bad exercise to go through before we write the report, but, I mean, this will be a long enough night, if your projections are right, Helen, about who's coming.
I called a couple.
I don't think we can spend more than about half an hour doing a presentation without
think?
losing
That's
people.
about
If
twice
people
as long as we ought to.
take
Yeah.
time out of their personal lives to attend, what do you think they're hoping to get out of
I was
an
hoping,
hour and a half?
I was hoping that we would say, give them a little overview and then ask their opinion. But if we ask them to just come in and tell us what they think, I can tell you right now. All but one person I talked to who says, I don't ever want to see a split tax rate. Of course, this person has millions of dollars. But other people that I've called up, and I haven't even met, that I've called and said, I'm on this committee, do you know anything about, well, yeah, our taxes are too high, we need to get them lowered. Well, that's not what we need to do. We need to say they can be lowered, they can't be lowered because of this, this, and this is what we've learned, or something like that, I don't know.
No, that's a good point.
So does it not make sense to do a kind of a presentation on the exemptions and how it all works? And then ultimately, isn't this really what we're
I
trying to
think
present
that,
to
that
people
chart
and-
is pretty much as succinct a summary of the split rate as we're gonna get.
something to this effect? Yeah.
I think we need to come up with something else along those lines for the residential exemption. And I think maybe it's sufficient just to have handouts on the exemptions themselves.
Didn't you have something last week in relation
On
to that,
the-
that you sent out?
On the residential exemption?
Yes.
Yes, but it was a worksheet. We can, all right, we can look at that again. Yeah,
That was
let's
very good.
revisit that and see. Yeah, because Mary, I think you're right. More than 15 minutes, we're gonna lose people.
Yeah, I wouldn't even think it would be 15 minutes, just give them and then let them talk to us.
Well,
It takes a few minutes to.
it's gonna take a couple of minutes to go through this stuff accurately.
Well, I think that everybody that,
That's Colleen's problem.
I mean, I think anybody that gets up to the microphone is gonna say, I want less taxes, being they're in the residential side or the business side, so.
If we present this proactively, it sets the framework.
The tone,
And
yeah.
then we're asking the question, is an average of $140 a year?
Is that something
meet your
that makes sense?
expectation,
Yeah.
right? As
Mhm.
opposed, because if you simply say, if someone shows up and says, I want lower taxes, once they understand that a scenario may be an average of $140 savings per year, 1,600 over 12 years.
And that the physical bill may have a higher number on it anyway.
I was gonna say, assuming we can agree on what we're looking at in
Well,
those
again,
terms.
I think that spreadsheet does a nice job of it. We have
It
to talk
does.
about different things on it,
Well-
but I think that contains most of the information we need to give people, at least about on the residential side, about what a split rate would do for.
I think this presentation, I don't disagree with the math, John. I like what you did, and it's eye-opening, but it skews the perspective.
How?
And if it's basically a question of, do you want ice cream or do you want a stick in the eye? If you're a residential taxpayer, this is just saying, hey, we're gonna lower your taxes. It's not showing that we're lowering them by much. But the other side of the coin here is you're whacking the small business community with what you're seeing on the right side of that
Well, again,
worksheet.
I think
But-
as long as we include
Well, there-
both sets of numbers, then people can see what the implications are.
My point with this, I'm not saying that we shouldn't be using this, but I think we need to qualify what this says. And this is saying this is a short-term fix to a long-term problem. The long-term problem is we need to increase our tax base. At the end of the day, this doesn't increase taxes, it just shifts taxes, correct? We need to increase our tax base. We talked about trickle down a couple weeks ago and, getting 129 rezoned and building that up. That's really the issue here. So, in my world, when I think about matching financing with assets in terms of financing real estate versus working capital, it's always, we want to match long-term financing with long-term assets. It's the same thing with this exercise here. We need a long-term solution for a long-term problem, not a short-term solution, because what's going to happen is we're going to do this, we're either going to raise taxes again or increase the split again. There could potentially be political implications down the road for tax overrides. I mean, it doesn't fix the problem.
But you're saying it's not sustainable.
Correct.
It's not
sustainable.
Not predictable.
But
That's right.
For
That's
anybody.
exactly right.
Your other thing, and you talked, I had this conversation about the levy, and the thing is, increase the tax base. What happens when we're bringing in new businesses and whatever? You're increasing, it becomes new growth, and that allows us to increase the levy. it's just the same thing. Now, if you can increase that tax base and leave the levy the same.
Well, that's
then-
another piece of, we
Yeah.
talk, that's the other side of the coin.
It's a whole matter of budget and
Yep,
what you
yep,
can.
but that's what, we're not here, we're not charged to talk about budgeting, our,
But I think that's another thing that
Yeah,
people don't
that's a
understand.
big
Every
thing.
time you bring in a new business with new equipment or whatever, it's all new growth. Am I wrong, Evan?
That first, yeah. well, that-
Most of it
that
is new
first-
growth.
That first year
And
it
what,
goes on
and
the
what do
books.
we do that allows, and we see Paul each fall or every budget season tell us how much new growth, and it allows us to increase the levy by that amount. And as much as we need that increased levy to perhaps provide additional services to cover raises or whatever, it doesn't.
need to control expenses too.
That's
Well,
right.
end of story.
Part of the story with 129 isn't just chasing new growth. It's bringing up the assessed values where properties don't necessarily experience traditional new growth.
Okay.
And I think town-wide, that's one of our challenges. Is it rents are low, depreciation rents are high? If one property owner invests significant money, then it's likely to have a domino effect.
And that can change that dynamic of what the percentages are of residential land.
Yeah.
Absolutely.
So my point, though, is I think if we're gonna provide this information to the public, we need to qualify what it says. You can't just say, this is what it is. There are implications to doing this. There's a story behind these numbers.
But once you give that story, you might find that when people look at this as individual homeowners, I'm going to save $1,660, but a business is going to spend $19,900, so $20,000. Well, we're trying to bring businesses in, so, I thought that I wanted my taxes to go down, but I might not want to because I want to build a town. You might have people jumping the other way, you might.
I just think you need to explain
That's
both
why I'm
sides of the
saying you
story.
need to, that's
yeah.
exactly why I'm saying you need to explain both sides so that they understand what this means and what this means. And then they might go with this versus this. Just a thought.
Do we want to maybe form a subcommittee to try to draft a presentation for the next? I'm just trying to think.
I know what you're saying. I tell
For
you
the
what,
next meeting prior to the 28th.
how about this? How about I'll spend a week throwing things together, because I'm probably the closest thing to a central repository of stuff at this point. Produce a rough draft for next week. Everybody can take it and work on it for a couple of weeks, or really
one
only
week.
1 week, and then on the 21st we'll have to put something together
I got two
for a presentation, and again, something that's 15 minutes long.
Yeah.
Okay, and Frank, a quick question. Would new growth in CIP that leads to an increase in the levy affect the valuation of residential homes? Is it contained within the CIP portion, at least for that first
Something
year?
occurs, a new commercial building is built that's pure new growth, so the CIP goes up by that amount. It wouldn't affect the valuations on the residential side. What does happen in that scenario, the CIP would go up, so therefore the CIP percentages are somewhat higher. Holding steady the residential, that would effectively go down by virtue of the CIP going up. But what's happening here, and I want to touch on some of the things Evan's been talking about, one of the goals of the overlay is to increase the base out there on 129, the 70-odd buildings we've identified. The likelihood that much of that will actually be growth is probably not very high. What we're looking for, once again, as Evan and Tom have kind of alluded to, in the kind of cluster occurrences that might come out there. A company comes in there with biotech, and it's sort of an anchor type of a business. It expands. It has other types of businesses just similar to that pay higher rents that make that building ultimately more valuable because of the rents they're capturing. And then that might have a spread effect, increasing the valuations up there. None of that is new growth. None of that is, other than any new additions that might be built, none of that is really found money for the town. What it does do is increase that base. So if the CIP is going up, and the residential because it's an inverse relationship, would be necessarily kind of either holding steady or going down, depending on the performance of the residential. One of the things that's also occurring now is that's driving the residential up, besides the valuations that are kind of outpacing the commercial, is the kind of residential new growth that we're experiencing. Mill Road is a good-sized project. That's residential. So that's driving it. We have some other things. The self-storage is commercial, but they're relatively modest in terms of the valuation in comparison to the apartment buildings. And what's in the pipeline, in terms of larger projects, and Evan can correct me on this, for the most part are residential. They're larger apartment buildings, Turnpike Road being the next one, I guess.
And those things are new growth.
Those are new growth, absolutely, which have the effect of, when you look at the percentages, it'll be seemingly driving up, it will be driving up the residential percentage. Once again, and then we have the residential, like Tom alluded to a few weeks ago, it's outpacing the CIP. We have a fairly good, 5 to 7, 8, 9% increase on the residential each and every year, condominiums as well as single families. The CIP, not so much. Up, but not nearly so much.
But the new growth bleeds the following year, right, to the other categories. In that first year, whether it's a new commercial building or a new residential place, it goes into that category.
That's right.
You have your levy, then you have your new growth.
That's right.
Next year's levy contains last year's new growth.
Exactly.
So, in fact, an increase on the commercial side in year one, some of that increase would bleed over to the residential side in year two, right?
Let's see, suppose we
Because
have,
the
once
levy
again, a
goes up.
commercial building contributes $7 million to the levy. And then that's new growth, that becomes incorporated into a permanent part of the levy. That's $7 million, and it produces several $100,000 in tax money. Year in and year out, looking forward, that additional tax revenue is paid by that very building that came up. So as long as everything holds constant, that same building will continue to contribute that tax amount to the town.
Okay, so as long as the new building, the whatever the new growth in year one is, appreciates in value at the same rate as the other classes,
Yeah.
then it kind of stays in its
Stays- 'cause
original
it-
class.
that,
But
the
if-
same building is paying the taxes year in.
But if it
goes
doesn't
down-
appreciate as quickly, or if it, then
Right.
then
It
some of that levy
Absolutely, because once
migrates
that
over.
happens, and a good example of that is I know of a community, it was in personal property, which is sort of a hidden thing in this. As a percentage, personal property is not a large component of our CIP. But when you look at it from a new growth, it's 40 or 50% of my new growth each year. It's a very high percentage. This one friend of mine in a town I won't mention had a large company with a huge personal property bill. Just because of the nature of the business, we're talking hundreds of thousands of dollars a year. It's new growth, it becomes a permanent part of the levy. Well, that business flames out, goes out of business. That money does not come off the levy.
Right.
So that is, in your scenario, passed on to the rest of the base.
Yeah.
You know what I'm saying?
Yep.
We don't have, I'm not anticipating that, but I'm just saying,
No,
to illustrate
but-
your point, how could it become
It
part of
does
the entire?
migrate occasionally. While we have you, you have an update as well, I think, on the
I do, I sent it to you kind
exemption.
of late in the day. You may recall the discussion became about what to do with how the DOR seemed to be handling the value attributable to the residential mixed use. In there, John did a great job kind of encapsulating all three of the options put before the selectmen. In any of the literature, it had me leave it in place and consider it in the calculation of the average residential assessment. However, in the options that they give us, it's clearly backed out. I researched it 3 years in a row, and they clearly removed that figure from and I couldn't figure out why. Several conversations later with DOR, they kind of they didn't really address the options thing, but they sent me an article that I forwarded to, which I thought was
Yep.
pretty good. And so basically leave it in place, build it back into the options tables, which I did, send a version to you
Right.
to hopefully update it.
So, yeah, I will, and yeah, that came through this afternoon, so I will update you guys with both the article and the updated spreadsheet. And then, John, do you want to try to incorporate that into your kind of overall spreadsheet, that 3 options?
Assuming I can figure it out, and if I can, I know who to talk to.
You'll see it right away. It's basically building it, but feel free to reach out to me or to Mike through whatever, yeah. Mike, if you want, where you're talking about producing something for the 28th, a kind of a one sheet encapsulating all 3, where I have a little more time on my hands in the beginning of, during the day, obviously, when you're working. Not that I don't work, but you know what I mean. Do you want me to take a stab at it?
Sure.
Get it
We'd
off to you quickly?
love
You
to see it, yeah.
You were waiting for that, I can just.
Anything you've got. I mean, again, maybe the basis ought to be just last year's presentation of the
Yeah,
selectmen.
part of it.
And
And maybe I can get that sheet that I think,
it is an excellent.
that John handed out, but I don't, if you could forward that to me, it sounds like the sheet that you're all passing out encapsulated the split rate scenario. Is that something you thought would be helpful for the, or is that something I did?
I think this is modified from what you provided.
Oh, okay. All right.
Today?
Yeah.
I didn't know what it was
No,
before.
if that's the one you talked about, I think that was based off the spreadsheet I had done, but.
Okay. Let me take a stab at it. I'll get it to you
Sure.
quickly, and then you can see if you want to kind of alter
Great.
something. Okay. Yeah.
Thank you.
Thanks, Frank.
Thanks.
Okay. Well, I'm afraid to ask, but are there any other topics that people
Why are you
want
looking at me?
to go over? Because I think it's good we had that conversation.
Gosh, yeah.
Anything? Yes. Did you bring enough for the entire class? All right. Is there any public input tonight? Would anyone like to address the committee?
Guess I'm the only one. Glenn Diggs, 220 Wellman Avenue, member of the Board of Selectmen, but I'm not here to speak for the board, just for myself. Well, you guys are doing yeoman's work here, I'll tell you. First, I just want to address Amina's presentation. I thought it was great. I thought she was very knowledgeable, but I thought it was one-sided. And I briefly showed her something when she left, and she agreed there is another side to the coin. And that is, it talked about the tax code in reference, what it means in relation to the new rules pertaining to an average resident. There's another side of that whole tax code that affects businesses. And that should be discussed as well. That the new code includes many, many ways for businesses to pay a lot less taxes on their own. And that should be discussed equally with the advantages and disadvantages of individuals. So, for my own self, I look at this topic, one of the ways to look at this topic is, I guess is the socialistic look at it. What is the ability of a taxpayer, whether it's corporate or an individual, to pay that number? And is it easier for our businesses to do it, or is it more easier for our personal people to do it? It is a socialist way of looking at it, but it definitely has some bearing on the whole topic. And John had pointed out in one of the reports he did, and I think I got it right, that basically the residential part of, not residents, but the non-business taxes are much higher as a gross number than business taxes as part of the whole mix of monies available for the government. On the other hand, anticipating the changes in the new tax code, the biggest benefit overwhelmingly is for businesses and not for individual taxpayers. That's a very telling point in the evaluation of where this should be. One of the things that came up was people who you were going to invite. And one of the people I had sent Mike was John Power. Recently, Evan, we had a Route 3 group meeting. It was extremely well attended. And John was one of the speakers on one of the committees that was at the head table at one point. And probably no one knows who John Powers is, but he is the principal of the real estate company that basically owns Apollo, the buildings on Apollo Drive. Apollo is considered maybe the only business properties in town that might be considered A-class properties. And I asked him if he would be willing to speak to you because he can address issues like, you've got these beautiful buildings, but they're empty. Why? Is it because taxes are too high? Is it because Chelmsford doesn't have a reputation? Is it because the buildings are not designed for today's typical smaller entities and startups, or they're really designed for one tenant? All kinds of issues that affect the ability of Chelmsford to grow their business side. So he agreed to meet with you if you reach out to him, and he's homegrown, meaning it's a Chelmsford entity. and could speak directly about that. You know, he might give you, you never ask the questions unless you really know the answer. I don't know what he's going to tell you, but he's certainly the kind of person I think you want is more of a Chelmsford perspective on things. One of the topics that came up tonight, it comes up every meeting, and that is, if you give them a break on their taxes, the residents, that it doesn't matter because next year their taxes are going up. All right? I can assure you that the Board of Selectmen know exactly what that story is and that the taxpayer will get that benefit every year, forever, incrementally, every year. Now, the taxpayer may not know it, but I guarantee he will be getting the benefit of it. And if you're going to present any topic at this public meeting, you need to get that across so that people are not mixed up on that. They will save that amount incrementally every year. Their taxes will be less. And the illustration that was given was that after 10 years, they will have saved $1,000. And their taxes would have gone up by $2,500, but without it, they would have gone up by $3,500. And that's something that people somewhat get confused about. You know, I have always said the taxes will go up, but they will only go up incrementally that same amount every year. And combined with that, I don't have the chart in front of me. John, I think you have it, was the original chart that I had prepared, which said there were three classes of business: business, $1 million, residents, there was 200,000, 400,000, 600,000, I think. And at the bottom of it was the increment of the split rate going from 1 to 0.5. It was a very simple chart. And I think that's where you start with the $161.
You talking about this?
No, it was very simple. And Frank, you know which one I'm talking about.
Yeah, I thought that was it, actually.
No, that was the big extrapolation. Anyway, the point is this. Part of this exercise is coming up and, again, suggesting recommendations where the split tax rate would be. But roughly, if they were to save $200 at 1% a year, that average house saving $200, if it was at 5%, that average person would save $1,000. And there's a lot of talk about this $161, this small number. But the board has it in its power to make that number up to 1.5%. I'm not saying that it will be one or the other. I don't know where it will be. We're looking for some guidance. But referring to the small number saying, well, it's really not that big a number and no one will care. There are people in this town, I guarantee you, that that number will mean something to. It may not mean anything to anyone here, but there are people who will mean that number to. And there are people in town, if we made it 1.5 and they saved $1,000, that wouldn't mean anything to them, all right? It's all relative to where you are. So, I'm saying, focus on the idea that it could be anywhere from 1 to 5%. Just to let you know, I asked Frank to prepare another report. He hasn't quite finished. He's about to finish it, which is on residential exemptions. And it's on one sheet of paper, what all the exemptions are, what all the qualifiers are for those exemptions. And one significant thing is on there, which I don't think you've seen yet, is how many people in Chelmsford take those exemptions. Part of who take it is dependent on if you qualify. So I think the largest percentage is veterans. Am I correct in that? All right, so if you're a veteran, you can qualify for it. That's a pretty easy one to say, are you eligible or not? But many of the others are income dependent, and you don't know the income of each individual unit to say, well, we've got 50 people, but there are 3,500 other people in town who qualify for that. Well, maybe they qualify it, but when you throw the income qualification in there, they don't qualify for it at all. So he's going to send that to you, Mike, and maybe you can send it out. But it's try to put it on one page to give you some idea of how many people do take these and the qualifications associated with it. And then there was some talk about, early on during Mina's presentation, about people pay attention, they're talking about it or they're not talking about it. You know, the fact is that if Chelmsford had enacted a split rate 10 years ago, there would be would there be a lot of talk about it today, or would businesses just expect it as normal? If you're in Billerica, you probably expect it as normal. You know, we said that, well, no one talks about it at the Rotary. I guarantee if we split the rate, Rotary, you're gonna hear about it at the Rotary, all right? Or, you know, in Frank's case, you know, they were saying, you know, trying to get it across to the people. Maybe on a tax return, we need a picture of Frank with $100 bills in his hand, right there on the cover, saying, this could be yours, all right? So anyway, I just wanted to kind of encapsulate what was said tonight. Again, I appreciate all your hard work. Thank you.
Thank you, Glenn. Okay. Press questions? No. That means it's time for Mary.
Oh, I don't have anything under action items? We've
Oh,
covered them all?
no.
I move to adjourn.
It would be 9 minutes early, just so you know.
Wow. I'm not gonna drag it out just
I
for,
move
just
to
for that.
adjourn.
We do have a second?
Sure.
All right, all in favor?
Aye.
We do have action items, but they're all mine.